Warning, the S&P opened up quite soft. It tried to rally. We had a massive drop. It looked like we were all but lost. The bears were taking over. And then in the last 30 minutes, like lightning, the bulls came in and they pumped the market back up. Ironically, basically right back to where we started, which means we went a whole bunch of nowhere. This can be quite obvious. If you look here at our one-day chart, we note that we have a massive doji, which means that we're basically opening, closing at the same price. And in a couple of moments, I'm going to show you exactly what I think the trap was. And if we look here at the heat map, this is a different way of looking at the same information, where on the one day, almost everything's red unless you are a weight loss drug, or if you're NVIDIA, AMD, or a credit card, almost everything else was down. But if we look here at the last 4 hours, basically the afternoon trading, not a lot happened, which means that the gap down is where most of the damage came. Otherwise, we pretty much treaded water or rallied back up to save the close. This all came on the heels of CPI, which gave us the biggest decline for the S&P, the NASDAQ, and the Dow Jones in quite some time. So we note that core CPI, CPI, and CPI year over year all came in quite hot. And this is bad because it means inflation might be back. So U.S. core inflation stays high, putting rate cut in doubt. Consumer price data comes in hot across the board. Cool. So now it puts the Fed rate cut for May in doubt. Is this really bearish, though? I want to remind you of a quote we've been talking about over and over. You're probably getting tired of seeing it. It's that we want to be patient, to wait. Otherwise, the market's going to probably transfer the money from us to people who are patient. And what that basically means is that now if we go here to our board, we note that above 492 is a bullish area. And on the annual, above 480 is a bullish area. So what I mean by it might have been a trap is that we did lose that 492 area, which is resistance that we had, and that is found at 492. Now, if we pop over here to the weekly chart, I want to show you that we got awfully close. The bears looked like they almost had it, but then they came in for the save. And it's only, what is it? It's only Tuesday today. So, man, there's a lot of trading left. But look what happened here. Basically, right down to the weekly higher low. 490.23, 490.72, which means we are within 50 cents of actually testing that monthly low. It got even closer for the NASDAQ, though. If we get here really close here on the weekly chart, what do we know? Let's just delete this crap, make it a little bit easier to see. Last week's low, 425.00. This week's low, 425.33. That is a save, and we're right back to support. The reason why I think you might be quite surprised about this is because if we look back in time to the last time we got really close to a weekly higher low, it was 3 weeks ago. If we go back here on the S&P, pretty much that same pattern here. We got so close. The low was 482.78. Here we got to 482.86, which means within 10 cents. So did the bears just get trapped? Is that what happened? Because it's going to be very ironic if that's what we did. So the fact that we came down to 492, lost it, but closed out with a doji, and now we still have a gap on the chart. This is where it gets quite interesting. We've now filled the lower gap here, but now we have an upper gap. And yesterday we actually had a topping signal, which was a failed breakout. I'm going to ask you for a huge favor before we go further. If you could please consider smashing the thumbs up and subscribing to the channel, I would really appreciate that. Thank you very much ahead of time. All right, so if we now go through the rest of this data, we will come back to look at exactly why this might be a little bit different now. So if we look at different charts, we're going to get different stories. So now, if we think about the S&P and the NASDAQ both coming down to basically the weekly higher low, if we now pop over here to our monthly chart, here's where it gets a little bit more tricky because the NASDAQ is now below 430 on a daily close. It's not by a lot. We closed here at 429.05, but it means that technically we are below the previous candle high. And this is not good because as we've talked about before, I think I have it on this week's data. If not, it'll be on last week's. A failed breakout. Nope, I don't have it here. Let's go back to last week because we've been talking about this topping pattern for quite some time now, which is the failed breakout. We talked about it on the daily chart. And if we go back in time here, it's not been a very good signal for the S&P, and it's not been a very good signal for Bitcoin. When we get these failed breakouts on the monthly, it usually leads to dramatic downside. Please remember, it's only February 13th, which means that we do not yet have confirmation. What do we have? We have a warning, but we have to be patient to wait until the monthly candle closes out to confirm what is truly happening. And I think the reason why there was a trap being set and why we got such a violent close is because there's a lot of short sellers. We're still basically in blue sky territories for both the S&P and the NASDAQ, but these short sellers just can't seem to help themselves. 233,000 contracts short. These guys are all underwater. And they've been underwater going all the way back to June of 2022, where the market just went up, up, up. And these guys could not seem to help themselves. They went long for 2 weeks, and they're like, screw it, right back to short. Well, they're eating some humble pie today. I can guarantee you that. So let's get out of here. Let's go back to our weekly note. And just to recap, over 480 on an annual perspective is bullish, and over 492 on a monthly perspective is bullish. We're definitely getting some warnings, but we do not yet have any confirmation. And I want to walk you through a few more quick things here. So we now got through our most important data point of the week, which was CPI. There was some earnings after the bell today, including Airbnb, Lyft, and I think it was Robinhood. But none of those are really going to move the market. What I want to take a quick step back here too, as well, is that we're seeing very high. It's not really high, to be honest. We're at 3.1. Like, come on, it's not really that huge. But we also have really hot GDP. So if we're getting really hot GDP at 3.4%, does it not make sense that we're also going to see really hot CPI? I think it does. And I think the really important question here is whether or not actually seeing no cut is bullish or if it's bearish. We've talked about this many times before, and we don't actually want to see a Fed pivot. The Fed usually pivots when something's broken. So right now we're in a Goldilocks scenario where they've pivoted, they've paused, but they've not yet pivoted. If you remember, we've been talking about this chart right here on SPX for quite some time, where we go through 3 scenarios. Let me see if this is the one I want to talk about. No, it's SPY. So if we go back to here, we know we got 3 bullet points. Number 1 is don't fight the Fed. What does that mean? We got the pause. The pivot is going to determine whether or not the recession happened or if we got a soft landing. The Fed has been very bad at avoiding recessions in the past, which is why we've seen declines as much as 50+%. This time could be different. I'm not yet sure it is. So with very hot CPI and very hot GDP, this data kind of makes sense. And what I want to focus on now is going to be something that's quite simple here. We want to focus on the continued strength, which we've talked about before. So again, echoing that Warren Buffett quote, that we want to be patient, because if this is truly declaring victory on inflation, which we're not sure, right? Today definitely throws a wrench into the situation. But we'll see what happens. If we keep getting continued strength, which is higher lows and higher highs, we don't have to overthink it. But as we talked about on the weekend too, as of right now, after we crack 5K, just like 1, 2, 3, 4, 1 month out, there's a 60% chance, basically a coin toss, that we're going to be green. And we're only higher by about 0.7%. Where it gets better, even on a 60%, is when we go out 3 months, where we're up by 3.9%. So it might be time for us to start going sideways. And what that basically means is that we want to be very receptive to the next data point, which is going to come out on Friday, because I believe that as we have it laid out here on our card, let me just go back to it really fast here. 1 second. Let me pull it back up. If we go back here to our second most important data point for the week, it's going to be PPI, which comes out at 8:30 a.m. And remember, producers produce and then consumers consume. So today we got 0.3 and 0.4 on the month over month for CPI. But remember, producers produce and then consumers consume. This is going to come in at 0.1. If we're going to get a nail in the coffin for the short-term downtrend, it's probably going to be on Friday. If we're going to get some sweet, sweet relief, it's probably also going to be on Friday. Thank you for tuning in. The weekend deep dives now queued up here on the left-hand side. If not, subscribe and join us for pre-market tomorrow at 9 a.m. Thank you so much for tuning in. I'll see you on the next one.